The domestic equity market is witnessing shifting tides in terms of performance within market capitalizations, sectoral performance and equity MF inflows. The breadth of the rally is narrowing. The number of stocks generating positive returns within the Nifty 500 universe has narrowed from 452 in Q1 financial year 24 to 268 in Q4 financial year 24. Most of the correction in the last couple of months has been observed in the small and mid-cap stocks, as opposed to large-cap stocks. 47% of the Nifty 500 stocks generated more than 50% returns in the 10 months between April 2023 to January 2024, of which 20% of the stocks generated more than 100% returns. While the small cap index fell 5% during February 2024 to March 2024, 24% of small cap stocks have corrected by at least 15% during the same period. There has been a declining trend in net inflows in the small cap category since October 2023. Multi-cap and sectoral funds have been receiving the highest net inflows since August 2023. Large caps continue to be more attractively valued compared to small and mid caps. Nifty 50 earnings has seen double-digit growth for 4 consecutive years. Earnings are expected to grow at a steady pace going forward. The temperature gauge index is in the fair value zone. For incremental allocation to equities, investors should maintain bias to large cap and multi-cap strategies. For select mid and small cap strategies, investors can adopt a staggered investment approach over a period of 6 to 12 months. There is a reasonable to high probability that domestic long-term G-Sec yields are likely to trend lower from their current levels over the next 1 to 3 years, for several reasons. Fiscal prudence, stable domestic macros, favorable demand-supply dynamics, inclusion of Indian bonds in global indices. The overall upgrade to downgrade ratio has stabilized. There are 3 factors driving the credit quality of corporates in financial year 24. Deleveraged balance sheets, sustained domestic demand, government-driven capex. Sectors leading the upgrades include infrastructure-linked sectors, auto, and education. We reiterate our view to increase duration in the fixed income portfolio so as to capitalize on the softening of yields in the next 1 to 3 years. 65% to 70% of the portfolio can be invested in combination of G-Sec, roll-down strategies through a combination of 10 to 14 years maturity bonds or funds, and for 20 to 30 years average maturity prefer to invest through G-Sec, MFs. Equity savings funds, which aim to generate enhanced returns than traditional fixed income along with moderate volatility through a combination of equities, arbitrage and fixed income instruments. To improve the overall portfolio yield, 30% to 35% of the overall fixed income portfolio can be allocated to select high-yield NCDs, private credit strategies and REITs or InvEITs. For liquidity management or temporary parking, investments can be allocated to arbitrage or ultra-short-term, minimum 6 months, or liquid, 1 to 3 months, or overnight, less than 1 month strategies.